Hi, everybody, and welcome back to video number 5 in Chapter 10. As you'll remember, we calculated $10 per ounce for the Evershine company in its silver mine. So, as we look at how we would present that, we're going to debit $250,000 here if we extract 25,000 ounces. So we'll debit inventory of silver for $250,000 and credit the silver mine for $250,000. So here's our silver mine at cost, $1 million. Our accumulated depletion is $250,000, leaving us with a remaining book value of $750,000. Okay, sometimes companies need to change the estimate of recoverable reserves. This is risky business, mining silver or gold. They do so either because they have new information or because more sophisticated production processes are available. Natural resources such as oil and gas deposits and some rare metals have recently provided the greatest challenges. Estimates of these reserves are in large measure merely knowledgeable guesses. Huh? And just to be crass for a second, we sometimes call those swags, scientific wild ass guesses. In any event, now this liquidating dividends is a little different. Here, a company often owns as its only major asset a property from which it intends to extract natural resources. If the company does not expect to purchase additional properties, it may gradually distribute the stockholders their capital investments back by paying liquidating dividends, which are dividends that are greater than the balance in retained earnings. Okay, so let's take a look at an example. Callahan Mining had a retained earnings balance of $1,650,000, accumulated depletion on mineral properties of $2,100,000, and paid in capital in excess of par of $5,435,493. Callahan's board declared a dividend of $3 per share on the million shares outstanding. How should they record this dividend? First of all, Callahan must inform stockholders that the $3 dividend per share represents $1.65, and we get that by taking this 1,650,000 divided by 1 million shares. Okay, and that the remaining $1,350,000 per share is a liquidating dividend. So it must inform that the stockholders of this liquidating dividend. So here, to record the $3 million, that's $3 times the million shares outstanding. Part of it's going to go to retained earnings, 1,650,000, and part of it is going to go to paid in capital, a reduction of paid in capital in excess of par on common stock, 1,350,000. And so that total cash out is going to be $3 million. Okay, a little bit complicated there. I think your homework will help you with that. Continuing controversies relating to accounting for exploration costs in the oil and gas industries. There are two primary views on that issue. First one is those who support the full cost concept argue that the cost of drilling a dry hole is a cost needed to find the commercially profitable wells. I certainly would take that point of view. But others believe that the company should capitalize only the cost of successful projects. This is the successful efforts concept. All right, let's put it into practice. The Mizy Mining Company purchases land at a cost of $2.38 million. It estimates that a total of 120,000 tons of mineral was available for mining. After it has removed all the natural resources, the company will be required to restore the property to its previous state because of strict environmental protection laws. It estimates the fair value of this restoration obligation at $180,000. It believes it will be able to sell the property afterwards for $200,000. Mizy Mining incurred developmental costs of $400,000 before it was able to do any mining. In 2025, the resources removed totaled 60,000 tons. The company sold 44,000 tons out of that inventory of 60,000 tons. Okay, so Alpha here, compute the following for 2025. The per ton cost, the total cost of the inventory, and the total cost of goods sold. And then prepare the journal entry to record the extraction or depletion of minerals in 2025. So our total cost, let's go back, we have the $1,960,000. We get that from the acquisition cost, plus this $180,000 restoration obligation, plus a return on that property afterwards of $200,000. Okay, I said that wrong. The additional incurred developmental costs of $400,000, not the $200,000. So we'll add those together, and we get $2,960,000. Now we'll subtract out what we expect to sell the land for as a salvage value, divide that by 120,000 tons. We get a cost per ton of $23. So if we remove 60,000 tons less the 44,000 tons that we actually sold, our inventory in tons will be 16,000. We'll multiply that times $23 per ton, and that gives us 368,000 as our inventory balance. The cost of goods sold, calculated similarly, is the remaining 44,000 that we actually sold times $23 per ton, gives us $1,012,000 of cost of goods sold. So now our inventory, we're going to establish here at 60,000 tons times $23, and the mineral mine, we're going to increase that. And then, okay, so we're done. Okay, we're going to demonstrate how to report and analyze property, plant, and equipment, and natural resources. And here, we're going to present that with these disclosures. 1, depreciation expense for the period. 2, the balances of major classes of depreciable assets by nature and function. 3, accumulated depreciation, either by major classes of depreciable assets or in total. And lastly, 4, a general description of the method or methods used in computing depreciation with respect to major classes of depreciable assets. Okay, let's take a look at an illustration. Here, the International Paper Company. It's showing property, plant, and equipment net for 2020 and 2019. And then it has a note, and it shows how they calculate these numbers in depth. Here is the pulp, paper, and packaging facilities. And here's the other plants, property, plant, equipment, gross costs, accumulated depreciation, and finally, our plants, property, and equipment net. Okay. I think that's pretty straight. Now, asset turnover. Asset turnover is a commonly calculated metric, and we get that by taking our net sales and divide it by our average total assets. So here's our net sales for the 3 years, 18, 19, and 2020, and our total assets for those 3 years, and our net income for those years. So we can calculate 2020 fairly easily. We take the net sales, and we're going to divide that by these average total assets. We get that by adding 2019 plus 2020 here and here, and divide that by 2. And we get 0.774. For 2019, we got 0.768. Pretty close as far as asset turnover. Profit margin on sales. Now, when it says profit margin, that profit margin does not have an adjective in front of it, like gross profit margin or operating profit margin. When it says profit margin, it means net profit margin, and net profit is our net income. So we're going to take net income divided by net sales. Very, very common metric used on profit margin on sales. This is how much we make for every dollar we sell. So in 2020, we hung on to a little over 9 cents in 2020, but we did much better because a little over of 7 cents in 2019. Okay. Return on assets, very similar here. We're going to take our net income divided by our average total assets. So again, we'll take our net income divided by the average total assets in both cases. We do better in 2020 at 7.11% compared with 5.53%. So the 2020 return on assets of 7.11% calculated here is the same result from multiplying the profit margin on sales times the asset turnover as follows. Okay. All right. Now we'll take a look at describing the income tax method of depreciation. Modified accelerated cost recovery system, that's MACRS, and MACRS differs from GAAP in 3 important ways. Very important here. MACRS is used for income tax depreciation. And here it's a mandated tax life, which is generally shorter than the economic life. The cost recovery is on an accelerated basis, and there's an assigned salvage value of 0 assigned salvage value. Okay, that looks like a good place for us to stop this video, and when we return, we'll continue looking at MACRS. Until that time, bye for now.